Hey guys, how you doing? So Dan from Trading with Dan here. We'll look at the Bitcoin and Ethereum charts. There's not too much to look at from an indicator perspective on the time frames that we use, because obviously we've had such volatility with this move down. Obviously we're going to be this still in the DMT sell trade with the DMT line coming down. And then we're obviously going to be in the 25-minute Dominator sell just because of the ferocity of this move down. But yeah, we can talk about what is generally going on though. We're obviously having a bit of an issue in the world's financial markets. We're clearly having liquidity issues, basically. So there's obviously a rush to cash, which has today started pushing the dollar up a bit. The dollar basket, where it previously has been getting sold along with this stock market weakness. And I mean, it's pretty. I mean, I've been saying for a while, we're obviously pretty much in the process of a credit event, and we're going to have a credit event, and credit markets are seasoning up and have been, which is why we've been having repo. The repurchase agreements going on for so long. Interestingly, today the Fed announced a 1.5 trillion asset purchase program, which is an astronomical number. But what is interesting is that they haven't called it QE. So I don't quite understand what it's going to take for the Fed to actually use the word QE again. I do know that late in last year the Fed was actually advertising for a spin doctor, someone to I can't remember exactly what the job description was, but it like a PR person or whatever, and it basically was because they needed to rebrand QE, because obviously I don't think it's that easily digestible by the public. So we've had the repo madness, which is basically QE, but sort of in a backdoor way to recapitalize banks. And then obviously we're having an asset purchase program of 1.5 trillion, but also isn't being called QE. But what that does tell you is that there is no money in the system. Like, there's no, people aren't lending, basically the money velocity is slowing down even more. So without that, it literally would seize up completely and go to zero. But this is the most worrying thing for the Fed right here today. So this spike up was obviously when they announced this asset purchase program. Big spike up, right? The Fed was thinking this is exactly what we want, and then immediately sold into, and then we just carried on the selling down. So I mean, that is a full on vote of no confidence with the Fed's ability to actually address what is going on in the markets. We also had a similar thing when Trump announced those basically tax cuts that they were going to do. The market had a bit of a brief rally, immediately sold down. I mean, we had the same thing when the Fed did its 50 basis point cut. We had a very brief rally, like obviously an algo driven rallies that move on. They just see the headlines and react, and then obviously when it gets sold into, they then flip their positions and sell. So I fully expect, I've said this in a few videos, one weekend just something's going to happen. The banks are going to open the same, something's going to be changed. I don't know exactly how they're going to do it, bailouts, bail-ins, whatever, but there has to be some sort of something happen. And I mean, it's interesting, the timing with obviously the global health issues that we have at the moment as well, that are probably going to make it illegal for people to gather in large numbers in places, make it illegal, obviously ban them from it, and also make them not want to of their own accord. When we're definitely gonna have some sort of a financial incident is happening here. I mean, it's already happening, and they're trying to put it out. But I mean, you could use the analogy they're trying to put out the fire with gasoline, and it clearly isn't going to work. There are clear differences between what's happening now and in 2008. So if we go over to the dollar index, look at a bigger time frame than that. So here, this is the exact point, February the 20th. This is when stock market started selling off. If we just quickly show you that on the yes, February 20th. Look, this is basically the date where we topped out. The stock market has been all downhill since then. So if you look at the dollar, it's that significant weakness in the dollar. That's basically a more than a 5% move down, which is a big move in the dollar basket. We had this. This is basically today and yesterday. This is what is causing, which is triggering this sell-off in Bitcoin, the sell-off we're seeing in gold as well. This is purely just a dollar strengthening, dollar priced assets going down play. So gold and silver and Bitcoin, basically pricing dollars have been going down because the dollar is rising. If we want to take a Fibonacci retracement of this, we can see that it's pretty much got to the golden pocket, the 618 golden pocket area, basically between the 618 and 660.5, 6.65% retracement, 0.65 retracement. So what that tells me is that this is just a counter trend rally to the 618, and then we're going to resume on down, selling off. So on the plus side, guys, this move up is what I believe has basically sent Bitcoin down. Well, partially what has sent it down, but this resumption of the weaker dollar could definitely see Bitcoin at least regain its footing. I'm not saying it's going to start a bull run, but I'm just saying if this does start coming down, we aren't really going lower in Bitcoin for the period of time that the dollar still keeps selling off. So that is good news. The funding rate on BitMEX as well is insanely high. So I mean, that just tells you that everybody is short, nobody is long. And you know what happens when everyone's short and nobody is long? That means there's no one left to sell. Only people left to either go long or cover their shorts, which is only buying. So it means markets will go up. So I mean, on that basis, I'm expecting some sort of a retrace, just purely on those fundamentals of the market. But I mean, the main thing is that I mean the dollar's coming off. I mean, the dollar's going to go down. Dollar's going to go down further. I think this is just a natural retrace of this move down, and then we're going to resume the downward trend. Also, I want to show you guys the US. Wait, we'll just get rid of that. Get rid of this Fibonacci retracement tool. Yeah, we're going to 10-year bond yield. If it's going to even load. Was that it? Oh, it was it. Yeah. So, oh yeah, because we're on the 4 hour. I was looking at it thinking that's not what I'm used to seeing. But yeah, so you can see bond yields were going down, going down a lot recently. Then we pretty much had the spike down to basically sub 0.4, and now bond yields are actually starting to go up. So if we want to look at this again, look at this large time frame again. If we look at this again from the scope of when February the 20th was, February the 20th was basically this level here. So the bond market this has been relatively stable, yields pushing up a bit, I mean, we've been in a zone, and then bond yields massively selling off as the stock market was selling off. But now bond yield, I mean, ignore this wick, I don't know why it's there, it's obviously just an error. Now bond yields look like they're starting to come back up. I mean, you could say this is it's not really, this is not a 618 retracement, a fib retracement. It's nowhere near. It's basically nearly the 382 retracement. But the thing is, what I'm trying to say is that I don't believe this is a retracement. Now I think the bond market is gonna it's going to keep going up as we start to factor in certain things. Getting quite a Bitcoin's going up a bit here, guys. And let me just show you, not that you guys will obviously know, but yeah, look, see, we're at 5,900 now. I mean, we double bottom this, so we're spiking up a bit now. We'll see what happens. Trapped in some more shorts. Maybe we're going to squeeze up now to squeeze them out. Maybe over 6,200 would kind of make sense. Squeeze out the people that shorted. But anyway, what was I saying? What was I telling you guys about? Yeah, the 10-year yield, the bonds. I mean, I think what we're going to have, what is different this time from 2008 is that the whole period of 2008 from March onwards, when the stock market was selling off, the dollar was also strengthening, because the dollar basically is a flight to safety trade into dollars. And that obviously puts an upward pressure on dollar. We're having the opposite happen here, the dollar go down. So I mean, what that says to me is that, one, this is definitely different to 2008. So whilst lots of people look back at 2008 through the context of silver and gold prices and think, well, yes, gold prices did have a big rally after, like 2010 time after, but initially they sold off. They sold off like about 30% initially when stocks started selling off, when we started to have the sell-off in the stock market in 2008, and that was obviously the buying opportunity where they then propelled higher, selling off for like, well, people will think like possibly for liquidity reasons, but that's only like on individual days. When you get a big move, do people literally just throw out the baby with the bathwater? But what it predominantly was just the dollar strengthening. So it's a flight to safety into the dollar, which is then pushing down gold prices as the dollar strengthening, as much as we've seen, much in the same as we've seen the past 2 days, with silver, Bitcoin, the dollar going down, silver, Bitcoin, and gold going down, whilst the dollar has had these 2 days of strengthening. But so what I'm saying is, if we're not having that, that means we're not really going to get the sell-off in gold, which means it's just going to be onwards and upwards for gold and silver. And as much as I'm not saying that gold and silver are correlated to the stock markets. I'm not saying Bitcoin is correlated to gold and silver and they're going to go up to Bitcoin's going to go up. But what I am saying is that Bitcoin has performed well in a weak dollar environment. So taking the stock market, the correlation stock market aside, if we have a weak dollar environment, that is going to be bullish for Bitcoin. It's going to be a bullish force for Bitcoin anyway. There are obviously other factors. I mean, you have to accept that we live in a world where everything's driven by multi-factors. There's not just one driver. Things aren't as simple as that. Things aren't just two-dimensional, one-dimensional. I mean, we live in a multi-factor world. So maybe we are gonna see at least Bitcoin get its footing again with the gold and silver markets. I mean, silver's a bit different because silver isn't a currency. Silver's not silver's an industrial metal. Gold is a currency. So gold is basically a trade against other currencies. It's a trade against real against real yields, basically nominal yields as well. So it is, yeah, that's what gold is. So if we're going to have a weakening dollar into this next crisis, which I think is very likely, the sort of stimulus that they're going to have to do is going to be epic to try and hold this up, and that is going to be massively dollar bearish. There's going to have to be so many trillions of dollars printed into existence, which is going to be dollar bearish. And it's not a case of just bailing out banks. It's not a case of the fact that the only real issue is the value of the collateral, i.e. the housing is lower, so we need to recapitalize the banks that now don't have that collateral of taking that loss. This is a case of they need to bail out everything in the entire economy. I mean, everything, and global health issues aside, that isn't what is causing this. That is just the trigger of what is as what has obviously triggered basically the credit event, the liquidity event, the basically because of the massive amounts of debt that accumulated in the system, the corporate debt, the government debt, and the consumer debt as well. I mean, that it can't go on forever. That bubble created by repressed interest rates, and money printing, it can't go on forever, which is why I'm thinking that the bond market is starting to unwind here. So it's going to be an interesting time so far as everything's concerned, really. I don't really know what's going to happen with stocks, because I mean, if the Fed starts buying stocks, the Fed starts causing actual inflation again, I mean, stock markets can do whatever they want. I mean, stock markets hyperinflate when currencies basically you have hyperinflation. So it's gonna be a difficult one, but I am leaning towards the fact that we're not going to have this big sell-off in the precious metal, and possibly not Bitcoin, because I believe the dollar is just going to be weak. I believe the bond market is going to unwind. Basically, we're going to have a stagflationary sort of recession. So that's obviously going to be negative for the bond market. I mean, one thing bonds hate is inflation. So that is gonna rear its ugly head, and the only way to stop that is higher rates, but they were never really going to have the rates higher than the level of inflation, so we're always going to have basically real negative rates in theory, if the actual inflation rate is higher than whatever the high interest rate is. Tough times ahead. It is, like I keep saying to you guys, it is a trader's market at the moment. None of these markets, there's nothing really you can buy and hold and invest in. Even gold's going to have its big swings around. I mean, like we saw with the dollar index, it had its swing up, its swing down, and that retraced. I mean, the markets are going to be moving around a lot. There's more money to be made just by trading these swings on a day-to-day, weekly swing basis. So that's all I've really got to say today. It's been a pretty crazy day. There's lots going on. There's lots going to be going on. Basically, we're gonna have all sorts of rules changes, laws changes, everything. They're going to do everything they can to try and preserve the system. So just expect things not to basically carry on the way they are. Like as soon as some of these big funds start trying to withdraw money out of stock markets, people start trying to withdraw. They can probably stop them doing that. They'll basically pass legislation not allowing you to do that. They're going to do everything here basically to try and preserve the system. And there's going to be things that's going to happen that you aren't going to expect, that people aren't going to see before. Lots of people trading these markets have not seen high interest rates ever in a market. They've not really seen stagflation. They've not really seen real inflation. It's going to catch a lot of people by surprise. There's a lot of momentum algorithms out there trading large amounts of capital in these markets, so any sort of swing is going to be exacerbated. I mean, there's going to be a lot of pendulum moves. I mean, the more you move in one direction, and then the more you're going to swing in the other direction, and so on, and everything's going to overshoot. You just got to expect the unexpected, guys. I mean, if I told you a couple of days ago you could be buying Bitcoin sub 6,000, you might have been thinking that was crazy. Literally weeks ago, if you're going to telling people that bonds were going to be under, the 10-year yield was going to be under 1%, people would think you're crazy, and we got to 0.4%, guys. So what is happening in these markets is basically anything and everything. I mean, it's not what people expect. And I'm telling you now, people are expecting gold and silver and Bitcoin to go, obviously, to keep going down. They're expecting the dollar probably to strengthen. They're expecting lots of things that aren't going to happen, just the same as they were all expecting stock markets to keep going up and up and up, and Apple to go up before, literally until February the 20th. People were expecting that to happen forever. Stocks weren't going to go down. People are expecting Tesla to keep going up to like say 2,000. People are expecting lots of crazy things that weren't true, and they're now expecting lots of other crazy things that aren't true either. And yeah, the market is gonna make a fool of a lot of people out here. So all I can say, guys, is yeah, just be careful. Like I keep saying this, everyone just got to be careful out there. Careful with what you do, with your position sizing, with what you think you know. I mean, the best strategy is to literally just trade the charts based on the indicators you use on the shortish time basis, and just take the trades. I mean, even if you're like, just look at these trades in the dollar. I mean, if you're just thinking about where you think, if you're just thinking about, how do I get rid of this? Is this? Here we go. So if you're just thinking like you've got a view on the dollar, I mean, since this year we've had a move up from like 96 to 100, from 100 to basically 95, from 95 to 98 again. I mean you could have whatever view, and in the space of basically 2.5 months, 2 and a bit months, you do you know what I mean? You could be playing the long trade there, the short trade there, potentially a long trade again. Maybe not obviously on a 5-hour DMT, 4-hour DMT, but other time frames would have got you long, would have got you short, would have got you long again, you would have been short again. I mean, that's just how you got to be playing these things. Yeah, the markets are just a trader's market now, guys. Anyway, right, so remember, none of this is financial advice. I'm not a financial advisor. Always do your own research. And then yeah, so sorry that the video did go on quite a lot. Well done to any of you guys that are listening to this end bit now and you're still here. But yeah, I will speak to you guys soon.